In today's educational video, I'm going to describe the one thing that drives all of our trading decisions. It doesn't matter if we're day trading or swing trading. A lot of novice traders view everything as random. There's so many ideas floating around in their head, they don't know where to start. I'm going to address that issue and I'm going to simplify it for you. Every system has a starting point and an endpoint. I do these videos to help you become a better trader. Perhaps you'd like to do the same for other traders. If that's the case, please subscribe to my YouTube channel, give the video a like, and share this with other traders, especially if you find this content to be useful. So the market is what drives all of our decisions, and you probably figured that out from the chart that I have up. Now, we can trade S&P futures, but in this particular system, we're trading individual stocks. 75% of all stocks follow the market, and that's why our analysis has to start here. There are going to be times when we're very, very confident in what the market's going to be doing. There are going to be other times when we're less certain, and that is going to determine how much size we trade, how much of a position we carry overnight, and what types of strategies we're using. We're trying to evaluate what trend the market is in. How strong is that trend? What methods do we use to determine if the market is going to go a lot higher or if perhaps it's starting to find some resistance? I kind of view the market as a marathon runner. During the journey, you can tell how fast their pace is, how many water breaks they're taking. There are signs of fatigue that you can see. In the early going, the marathon runner is going to have a great pace. They're going to be clipping along. They're not sweating at all. Everything looks fantastic. But as they start to get toward the end of the journey, then you're going to start to see more water breaks. They're going to have heavier breathing. Well, the market kind of follows this same logic, these same patterns. And the way that we can determine which stage we're at is by the price action. I'm going to give you some real basics on price action, but in essence, what we'd like to see is we would like to see long red candles, and I'm talking from the long side. Now, the market goes up a whole lot more than it goes down. Just bring up a 100-year chart of the S&P 500 and you're going to see a straight line higher. So the majority of the time we're trying to join that longer term trend. Now, that's not to say that we don't have bear markets. We certainly have plenty of them, and we need to be aware of those situations, and I'll show you how to determine when we might be seeing an inflection point in the market and kind of how all of our confidence and our psychology plays into trading. Yes, most of the time we're going to be trading from the long side, but we're going to know what those warning signs are that the market might be ready to roll over or hit a soft patch, and that's when we're going to be in cash. We're going to be watching what the market does and how it comes in. During those periods, we're going to be on the sidelines waiting for that dip, and then we're going to gauge the depth and duration of that dip. But in general, when we're looking at price action, it's how one candle relates to the next. And so when we're in a very bullish environment, what we'd like to see is when we have these little brief dips like this one right here, we want to see these red candles erased immediately. Well, what does that mean? Yeah, the next candle would be ideal. That would be perfect. But if it's in 2 or 3 candles, that's fine. Every time that we see tiny little red candles, we should actually be embracing these if we are long the market, because these are the tests. They're going to gobble everything up in sight, and anyone that dared short this little move right here is going to be trying to reel in their shorts, and they're actually going to help fuel the move higher. When we see red candles and when the trend is strong, we want those red candles reversed instantly. Like right here, get a nice long red candle off of a relative high. The next day, the market tries to get some follow through here. Let's zoom in. You can see that tail underneath that candle tells us that they tried to sell the market off, but it closed on its high of the day. That was enough to tell buyers that, oh yes, this trend is still firmly in place. And then long green candle, this red candle was instantly erased, and that tells us buyers are still in control, and that gives us confidence to add to our long positions. So where are we going to have the greatest confidence? Well, first of all, since the market's in a 100-year uptrend, anytime that we've had prolonged selling, that's already going to tell us that these long-term asset managers are always looking to place money. They're always waiting for signs of support. And as soon as they see them, they're going to start piling in. First move out of a deep trough like this, these are going to be your good opportunities. So here, earlier this year, this was all tariff related, and we saw this big sell-off. Look at the size of this long green candle here. This is a bullish engulfing candle. Huge move higher. We've got a downward sloping trend line. Okay, breach to the upside. We have a higher low double bottom. These are the minimum things that I'm looking for to tell me that the coast is clear and that I can start considering the long side. Double bottom, higher low, breakout through a VWAP Q. Okay, in here, I am starting to get bullish. So as the market starts to rally up, what would we like to see? Well, we'd like to see better than this price action. This is not ideal. This is kind of floating higher, tiny bodied candles, very compressed with long tails and long wicks. This tells us that there's currently indecision right in here. Buyers and sellers are pretty paired off. They're really looking for information to drive the market higher. When we do get through major moving averages on the upside, we don't want to poke at them. We want to blow through them. And that's exactly what happened here. Along the way, when we're looking at the type of price action that we want, we always need to keep in mind, how are we going to know? What's going to give us that level of confidence? So in this particular case, I didn't embrace this move, to be quite honest with you. I felt that there was still a lot of pending news out there. We didn't know for sure what the tariff outcome was going to be, if these trade deals were going to be struck. It felt like this was a big short covering rally. In here, I told myself, all right, I'm not going to fully engage this market. I'm going to stick to day trading right now. I'm happy day trading from the long side, but I'm going to keep my overnight exposure fairly light. As you're conducting technical analysis, you're telling yourself, well, okay, well, what is it that I'd actually like to see? What's going to give me that level of confidence? Well, I'd like to see a test of the breakout, and then I'd like to fly off of that breakout. That would tell me that the buyers that missed this move right in here are not going to miss another chance. That's exactly what happened. Was we tested the 100-day and 200-day moving average, and then we flew off of it. This was the key candle, and this was also important because we didn't stay there long. Well, what does that mean? If you're down here testing this support level, it tells you that buyers really weren't that anxious to get long there. There was some selling pressure. When you're there briefly for one brief little day, you know that buyers were so aggressive. They didn't miss that opportunity, and now they're continuing to buy, and then you get your lift off in here. So this is a really good entry point for longs, and then you ride the position. So what are we doing in here technically? Well, we're starting to get close to this horizontal resistance right in here. In fact, we're just below it. Compressed, tiny bodied candles. Nothing really going on. They're mixed, meaning one day you got buyers, one day you got sellers. The news was still very fluid, so there wasn't a lot that you could really sink your teeth into. So when you bought this low right in here and the bounce off of it, this is where you're fairly aggressive, and now you're kind of seeing, well, this is a marginal new high right in here. These are the warning signs. So when you have nice rallies and the market does have a dip, you'd like to see the market rally right back to that previous high and then go through it with ease and make a substantial new high. Not a marginal little new high, not a wimpy little new high, not mixed overlapping candles with tiny bodies. No, you want to see big volume, long green candles. That tells you that buyers are aggressive. Well, we didn't really see that in here. All right, so you start taking some gains on some of your swing positions in here. You've been able to ride that for about 3 weeks, maybe a month or so. And then let me gauge what the dip is going to be looking like. If it's brief and shallow, those buyers are going to come in and they're going to scoop it back up again. So we get this little dip and we get 3 days worth of downward movement, and then we get a nice long green candle in here. Okay, you know what? This move never really got going. And on this particular day, the market probed lower. That's why you have this tail underneath the candle, and it closed on the high, and it closed above that prior red candle. Nice. I could feel pretty confident given that we've come out of this longer term sell-off. The market's been able to bounce. It's well above all the major moving averages. The one little test that we had of the breakout passed with flying colors. So we get this nice little pullback in here. We get this candle. We can start nibbling. Oh, the next day, breakout to a new relative high. Great, we can get long in here. What would I like to see? Well, if I'm starting to buy in here, I'm cognizant that I've got a horizontal resistance level coming up right in here. So am I going to go gonzo? No, I'm not going to go gonzo. I'm going to be looking for that level to be penetrated with ease, and I want to keep moving through it. If I get that price action, I'm going to add to positions. What did we do? Blew through it. Okay, if you're a stock trader, you don't have to be an option trader. Okay, let me make that perfectly clear. What you're doing is you are varying the size of your bets. In some instances, you're only using a small portion of your capital, and then you're adding to your positions. And now you're exposing more and more of your capital. But as the market continues to perform, your average cost is well below the current price of the market. So you're able to add with confidence, knowing worst case scenario, you can bail out of the position and scratch the trade, meaning you can get out at your average cost for the whole kit and caboodle and not lose any money. That's what gives you the confidence to continue to build the position. So now I'm adding to the position. When you are swing trading just with the stock, there will be times when you may feel so confident that you are going to be using margin and you're going to be leveraging your account. That's fine. If you've got that level of confidence and your average cost is way lower, okay, because you know you've got that safety net. You know you can always bail out and scratch the whole thing. You're not going to. There are going to be other opportunities for you to take profits, but that mentality will at least allow you to build your position. And a lot of trading is about confidence. So it's knowing when you can really extend yourself and knowing when you have to be more passive. And you do need to have big positions. You can't always trade the same size. I equate this to a blackjack player. He doesn't bet the same amount of money on every hand because every hand is different. When his odds favor him, he steps up and he bets more. And that's what you do with trading as well. So as this rally continues, and we're going to go back and take a look at other periods too, because I don't want to just show you what's happened recently. I want to show you how you adjust your strategy and your exposure over time, given different market conditions. So as we continue forward, yes, we break out. This is a really nice move in here. And so now we've actually added to the position. What do I want to see? Again, this is reading price action. If I get a dip, I want it reversed quickly. I pointed this out earlier, long red candle off of a new all-time high, and there's your bullish engulfing candle. I kind of like that. That tells me that buyers are still engaged, that this little round of profit taking is not going to get very far. And then we have a long green candle that closes to a new relative high. I could add right in here without too much concern. So again, my average cost is going to be well below this green line. That's a VWAP-Q. But if we started taking positions back in here, let's just use a VWAP-Q and say that this would be our average price. But it's going to actually be lower than that. So now you get into this little area here. This is a marginal new high. You've got tiny bodied candles. You're kind of thinking, well, I'm pretty happy with my profits so far. I could take them and I could lock them in. And if that was your case, you're happy taking your gains. Now you're waiting for a dip. Then you get the dip, and now you can see that it's reversing pretty quickly, bounces off of a VWAP. But the problem is that as the market starts getting to this point right here, you can see that these are marginal new highs with tiny bodied candles. This is the marathon runner who's getting towards the end of the race, and they're starting to get pretty tired. You know that now, instead of going long for very long-term positions, meaning you're hanging on to these swing trades for, let's say, a month or maybe even 2 months, now you're starting to narrow your time horizon because you're in more of a hit and run mode. Instead of being in trades for that amount of time, maybe you're in them for 2 or 3 weeks. And now you're going to have to start timing some of your entries because the market is showing you some signs of exhaustion. And so you can see that as this rally continues, we've got the same kind of pattern in here. But again, we're not trading S&P futures, we're trading stocks, and those stocks should have the strongest patterns. They should have relative strength. They should be making continuous new highs. They should be performing better than the market is. So even though this is what the market's doing, this is our gyroscope, if you will. This is what keeps us on track. The individual stocks could be performing much better. So let's say that you didn't do anything. Let's say that you saw this long red candle and you saw this red candle and you went, oh no, everything in here, I'm back to even. And you're in panic mode because you've got a fairly large position. Well, the first thing that you should do is to just take a very deep breath. You should know that there's going to be some profit taking along the way. Just basic, simple profit taking. Okay, these algorithms and these programs are going to test the bid. And when they do that, they're going to try and shake you out of a position. So what you need to have is the notion that this 100-year bull market, it's not going anywhere fast. And instead of focusing on this, which is a mistake that a lot of traders do, they see that first red candle and they hit the exits. They puke everything out and they go, oh my God, that's it. This is all over. You should welcome these red candles because when they reverse and when you see this level of strength previously, then in the back of your mind, you should be telling yourself this one thing: bull markets die hard. They are like the boogeyman in a horror movie. I mean, you could stab it. You could shoot it. You could set it on fire. You could run over it with a car and they still come back. So these buyers, they're not going away, and they're certainly not going away quietly. At very least, what you'll see is an attempt to get back to the high. Let's say this is a little bit deeper, and now all of a sudden you're thinking, okay, this is more than just a simple round of profit taking. Sellers actually had some say. They were able to drive the market. Now I have to be a little bit more cautious because the drop was deeper than I've seen before. It penetrated some major moving averages. It languished around those major moving averages instead of flying off of it like we like to see. You need to be a little bit more careful. As the market tries to recover and you get that lower high, okay, you know what? This was more difficult for the market to get back to that prior high than I had wanted to see. So now I'm going to start exiting some of my bullish swing trades, but I'm not going to puke out of it right here. I'm going to have confidence that the market is going to make that lower high double top, and lo and behold, right in here, hey, we actually made a new high, a marginal new high. Whew. Back in here, I was really nervous. Now I've got a second chance. I'm going to take my profits. Now I'm going to start shortening my trade duration, playing it a little bit closer to the vest and seeing what happens. So you get another little dip in here. What do I want to see? I want to see it reverse instantly. Oh, great. It did. Did we make a new high? No, we just kind of poked through it. So now in here, I'm thinking, well, the market is not demonstrating the same level of strength that it did back in here. But by all accounts, these dips are still very brief and shallow. So that long-term trend is intact. It's just that we're starting to see a little bit more choppy price action. Now we start making a new high in here. This is not anything I want to fully embrace. What does that mean? What does fully embrace mean? Again, this is all about our trading confidence. When we are super confident in the move that's going to be taking place, That's when we can swing for the fence. That's when we can build large positions. That's when we can hold our positions for a longer period of time. If we're back in here and we see this really nice point right in here where the market flies off of it and we start having an excellent level of confidence on a new all-time market high, okay, we can buy some longer-term calls in this situation that have 2 or 3 months worth of life in them, with the expectations that we're going to be riding this position. I personally like buying in the money calls. I always want to buy options that span the earnings announcement date because those are going to retain their value, their implied volatility right into that earnings announcement, which I'm going to be exiting those positions before the earnings announcement. I do not hold over earnings, period. So I'm going to be getting out of the trade, but the options actually span that earnings announcement date. I'm in longer term calls in here, delta of 0.70 in the money. It's a way to use leverage. Those options are going to move point for point pretty much with the underlying stock, 70 cents to $1. It's going to give me really nice upside movement. But as I start getting into this kind of really tiny compressed candles, light volume, float higher, it's almost like a seller's boycott. There's just really not a lot of volume. There aren't a lot of sellers, so there's not a lot of profit taking, but the buyers aren't very aggressive either. So what do you do in this case? Well, I'm still bullish, but I'm kind of neutral to bullish. Okay, well, that market assessment is going to determine the strategies that I use. And if I'm an option trader, what I'll be doing in this case is I'll be selling out of the money naked puts on very, very strong stocks that have nearby technical support. And if the stock happens to pull back to that technical support, I'm going to take assignment. I'm going to be able to buy that stock at a really good price, knowing that I have the market tailwind that I need, but I'm not going to go gonzo with these positions. And by selling an out of the money put, I'm giving that trade lots of breathing room. Okay, this stock can pull back. Oftentimes this stock can pull back 5% in a matter of weeks, 10% in a matter of weeks. And I still won't be in trouble on those naked put rights. And those naked put rights are generating somewhere between 5 and 10% over the course of 3 or 4 weeks. Those are really nice returns. Here we go. We're getting this long red candle. Whoa. Well, does it penetrate a major moving average? No. It finds support above the 50-day moving average. Well, okay, I'm not crazy about having a long red candle like this. And my confidence is still bullish. I mean, it's not over the top bullish. What do I want to see? I want to see this long red candle erased as soon as possible. Well, again, what does that mean? Well, yeah, I'd like to see a long green candle just like this. I'm not going to get that very often. So we get back to the midpoint of this long red candle, and then we gradually work our way above VWAP. This is the volume weighted average price since triple witching. And this is where a lot of institutions make their decisions, or at the end of the quarter during triple witch. That's why I find this to be relevant. It is a support level that I monitor for the indexes. As we get above it, okay, now we're above the halfway point of that long red candle. The move was one and done. One day. This was not 2, 3, 4 days of selling. All right, I'm starting to get a little bit more confident. The bullish put spreads that I've sold are still out of the money. They're not in any danger whatsoever. And so now the market continues to rally up. Now that takes us to the present day, and I'll tell you what I was looking at last week. And you're going to know this because if you watch my videos, I've mentioned, well, what would get you bullish? What do you want to see? I didn't like this move up in here, okay? This was a big gap up overnight. Then we had another big gap up. Then we had another big gap up. This is just ahead of earnings season and the FOMC announcement. So I didn't care for that price action a lot. From a swing trading standpoint, what did I want to see? I wanted to see this breakout from right here. This is 674. I wanted to see that challenged, and I wanted to see the market fly off of it. We're testing it right now. We've tested it twice. What I wanted to see today, I didn't really get. I wanted to see the market close on its high of the day, and it didn't do that. How am I approaching this? I'm not doing anything right now. I'm seeing if the market is going to probe a little bit deeper for support. I'm still waiting to see that long green candle. The breakout has been tested. Now I want to fly off of it. And it's so important. Why do I want to see the market fly off of it? Because it tells me that buyers are interested. They're not going to wait around because they don't feel that they're going to have another opportunity to buy at this favorable price level. And that's why for all these dips, I want to see urgency. Our ability to predict future price movement is based on urgency. And that bears out in the price action. When we get a little dip, we want it erased as soon as possible. It was a test. The market passed the test. When we have these confirmation points along the way, our confidence is very high. When we're trading stocks, these tests are so important to us because when you get the pullback, like right here, you're looking at your super strong stocks. If they didn't flinch and they held their previous price levels, oh, that is a sign that institutions are in there gobbling those shares up. Well, how do I know that? Well, that's what relative strength is, okay? The whole market is down. 75% of the stocks follow the market. When the market's down and these stocks are treading water, that tells us that all, the stocks are in these baskets. And when these sell programs hit the market, those stocks are in those sell programs. And all of those shares that have been sold along with that sell program are being absorbed by buyers, not short-term buyers, long-term buyers. Market down, stock flat, that equals institutions buying, especially when the stock has been trending higher because it's had really good gains. If there were going to be profit takers, that's when you would see that stock pull back. And when it doesn't, they're hungry for more. So those are the signs that you need to be watching for. So let's go back and take a look at how we'd be approaching other market situations. This is back probably in 2014, I believe. Yeah, 2014. Very choppy times. So what do we do here? Our market confidence is super low right now because we've got mixed green and red candles. Is the market moving higher? Yeah, but not convincingly so. Sellers are able to impose their will because we can see lots of these red candles. Well, this is an excellent time to stay very short term, focus on trades that might span a week or 2 or 3, and to really sell premium when you've got this type of volatility below major support levels. So really distance yourself from the action and err on the side of caution. What you're waiting for is that 100-year uptrend is always looming. It's always there. There are always buyers. And one of the things that you have with the 100-year uptrend, and one of the reasons that the market dies so hard, is because the Fed is always waiting on the sidelines for bailouts or quantitative easing or rate cuts. And as soon as the market gets that type of news, then whoosh, it rallies and rebounds miraculously. So in any event, these long pullbacks in here, as you start extending up in here and you get a long red candle and now you have a marginal new high, it's like, oh, the market wasn't able to get very high. So I'm going to be taking profits on any type of long positions that I took in here, waiting to see what the next dip was. And we've had plenty. You can see those in the chart. So now you get a bullish hammer followed by a long green candle, almost a bullish engulfing candle. All right, in here I can take a chance. I can start selling some more out of the money bullish put spreads. Would I be in here buying long-term calls? No, I don't have that level of market confidence. So now the market gets back into this choppy kind of mode up in here. you're going to be selling premium as much as you can. And marginal new highs, you're distancing yourself from the action. You're waiting for these drops because these drops are where you actually have some confidence on those rebounds. So you're waiting for these long bullish hammers, bullish engulfing candles off of a relative low. Then you can feel pretty confident in here selling puts. You get another little rally in here. These puts are going to expire worthless. No new high in here. In fact, lower high, double top. Uh-oh, would I be shorting? No, I don't have that level of confidence to be shorting either. If you're day trading, you can do anything. So day traders are very flexible. It's one of the beauties of day trading. But from a swing trading standpoint, no. You're waiting for support. Bullish hammer, followed by a green candle. Okay, off of a support level here, off of previous support down in here. Yeah, I'm feeling pretty good about here. Good enough to sell out of the money puts. Good enough to buy stocks that have been able to weather this pullback that have relative strength if you're a stock trader. In here, you get a retest, not panicking. Those puts are still way out of the money. And now we start seeing some pretty decent price action in here. In fact, if we start drawing some horizontal resistance lines in here, this is a pretty nice rally out of this deep trough, okay? So now we're getting a little bit more confident. In here, knowing this previous choppy price action, what would I want to see? Well, pretty much what I had explained to you just a few minutes ago. I'd like to see this horizontal breakout tested, and I'd like to see that test pass with flying colors. So when we test it, I want buyers that miss this little move in here to feel like they're not going to get a second chance to buy. And so we get this little pullback in here. We get a rally above the 100-day moving average. Okay, that's nice. Relative to what we've seen in the past. Relative to what we've seen in the past. This dip was brief and shallow. And we had a nice long green candle off of that red candle and right through the 100-day moving average. Nice. I'm feeling pretty good about this. I think I might be able to sell some puts in here. And if we test this breakout successfully and we fly off of it, it's going to tell me that buyers are now aggressive. They see this as a really good opportunity. And so, yes, we start to see that. And now we can actually consider adding to our positions in here. Wow, look at this. This is nice. Get a long green candle. These gains have to be digested. Digest. What's missing here? There's no pullback. Buyers have been waiting for a pullback. The guys that are still missing this move are waiting for a pullback that never comes. What does that tell us? Tells us that buyers are so aggressive that they're eating everything up. They're going to be chewing away at this compression, and we can expect another leg higher. Well, there we go. You can add to positions here. Now, what am I doing? Am I still selling out of the money bullish put spreads? I can, but I can actually start to shift gears a little bit. This looks like a longer term breakout. I can start buying some longer term calls in here. Do I go gonzo? No. Always starter positions. Wait for confirmation, add. Wait for confirmation, add. Position building. Hey, look, we're above that 100-day moving average and we're not even testing it again. Back in here, below it, below it, below it, below it, all over the place, above it, below it. No bueno, no confidence. Now the market doesn't even get to the point where it's testing that major moving average. And you can see how this turns out to be a really nice rally. And I know what you're going to say. You're going to go, wow, look at this, Pete. How could I have predicted that? Look at how strong that market move was. We should have been bye. Well, actually, this is what I call an H plus trend line. And usually when you break out above it in that fashion, that's going to be a buying climax. And we had a really nice trading channel in here as well. So yeah, I was expecting a buying climax in here and we got a nice pullback off of it. So once the market starts to go parabolic like this, you see how that curve is pointing up, then you know you should be taking gains. And we use EMA 8, and when the market distances itself from the EMA 8, which is not that often, to this magnitude, you know that it's getting overextended and that the market's vulnerable to profit taking. So yes, you would have been taking profits and staying very short term in here. So now you get this dip. Now what are we looking for? Well, we're looking for resolution to that dip. And here we get into 2018. So that's how our confidence changes. Now, what happened here? We had this blow off climax. We had a big, deep drop in here. We did have a pretty instant rebound. At what stage in here can I start to get comfortable with buying? It's going to take a breakout right in here and a test of the 100-day moving average before I could have any real confidence. Is it back off to the races? I'm not so sure. I'm not seeing it in the candles in here because they're overlapping with lots of tails and lots of wicks. It's not green bodies without that. So as we get in here, this is in October of 2018. This is a marginal new high. Remember how I mentioned to you that what we'd like to see on a new high is boom, 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 just marching straight higher. We don't get that. And the longer it takes for the market to advance and to make those substantial new highs, the more leery we have to get and the more inclined we should be to take profits. Well, that turned out in hindsight. I could use hindsight here and say, yeah, that was a good time to take profits, but the price action in here was already suggesting volatility and we weren't getting that push higher that we wanted to see. So we should have been relatively cautious. In here, this is a big drop. I believe the Fed started to raise interest rates in here. So what do we do with this information? Well, this is a weekly chart, but again, you're in passive mode in here. Long red candle. What do I want to see this long red candle do? I want to see it erased quickly. It takes 4 weeks because this is a weekly chart. So we're above it here. Am I excited? Not really. There's a downward sloping trend line here, broken to the upside. We're back above the 100-day moving average. Okay, from a put selling standpoint, from a long only standpoint, from a swing trading standpoint, this is where I can start to embrace the market. What do I want to see? I want to see a substantial new high when it's tested. Did we make a substantial new high? No, we kind of poked at it. We couldn't really get through it. So no, I'm still passive in here. Got a little bit of a pullback and a bullish engulfing candle. That's actually quite nice. That tells us that this little dip off of that high was bought up by institutions and that this could pave the way for a nice move higher. And so that's exactly what happens. But this is another little marginal new high and we've got a pullback. So all these marginal new high pullback, marginal new high pullback. This is not great price action, okay? Now we finally break through and we start stacking some green candles. All right, we can get behind this move in here because we're just marching higher. So this is pretty good. We get a little bit choppy in here and now we get into COVID. And once I saw this in here, I was already starting to exit my long positions. I was largely in cash during COVID. Go back, check my videos, you'll see. So then the COVID crash comes. The end of the world. Well, this long bullish engulfing candle and the speed with which the market fell apart told me that this was not going to last long. This was a knee-jerk reaction. What we don't want to see from a bullish standpoint is we don't want to see prolonged red candle, 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 and this steady selling pressure. That is just outright bearish. But when the bottom falls out like this, a lot of this, I believe, was caused. It was panic for one, and for two, it was that a lot of people had been selling premium. That was one of the most crowded trades in the business at the time, was that option implied volatility was being sold. And so when it exploded, it forced a lot of those traders to cover their positions and to take massive losses. And that's part of the reason that the market fell so far so fast. But once I saw this long green bullish engulfing candle, we were selling puts like crazy, naked puts, like mad. And this was off of a horizontal support level. So go back and watch my videos. I know we sold some Google puts. I think the stock was at $1,150. We were selling the 650 puts that expired in 3 weeks for $5. I mean, the premiums that we were No, we sold it for a lot more than that because we made a 5% return in 3 weeks and the stock would have to fall another 50% for us to even get down to that strike price. Tech stocks were super strong. We could see the relative strength. So this is a massive buying opportunity. Did I get aggressive in here? I waited for this breakout above the 100-day moving average and I wanted to see it happen very, very quickly. We had a pandemic. I didn't know it was going to happen. I've never seen a global shutdown. So I was selling puts all the way up. And I think in the course of this year, I think I did 100 trades. I had 96 winners. They made 25% on average. And I think the 4 losers that I had, we closed them down for not a full loss. They were probably like maybe a 20% loss, but really good strategy. So again, my point to all of this, and I'm getting a bit long-winded, but I hope I've given you enough different market exposure to understand how the market drives all of our trading decisions. Our confidence is going to ebb and flow based on the price action that we see. When you see a red candle, you want it erased immediately. You don't want it erased 2 or 3 bars later. You want it immediately. And that immediacy tells you that buyers are still engaged and they are aggressive. When you see dips that last 2 or 3 days, you want them erased in 2, 3, 4, 5 days. You don't want them to linger around. When the market tests major moving averages, you want it to fly off of those moving averages. You don't want to linger around. You don't want to poke around. You don't want to spend time below it. You want to fly off of it. That's when you know buyers are aggressive. That's when you can have confidence and take larger positions because you know that that trend is strong and those buyers are aggressive. If you have future content that you would like to see for these videos, please let me know in your comments. The reason I did this video is because I had a number of you ask how to trade the market, how to set yourself up for these swing trades, and how to read these market conditions. See how we trade live every day and take our 14-day free trial. I won't even ask you for a credit card. Dive into the action and trade alongside of us. Your downside is that you get some great trade ideas. Your upside is unlimited because you'll learn the skills that you need to be profitable. Check out OneOption.com and see for yourself.